Welcome to RegNut, your source of news, views, and knowledge on all things risk and regulation. I'm Walid, and I'm joined here with my co-host, Isaac, the man I hold responsible for introducing me to regulation. Hi, Isaac.
Hello. Yes. Well, I'm happy to take that responsibility. That if that's all the responsibility I have to take, we are in good shape.
That's what you should be known for.
That's fine.
Uh,
Everything else is your responsibility.
Great. So Isaac and I have been thinking about rebooting RegNut, but in a way that works around our work schedule. So the way we are thinking about doing RegNut going forward is it's a sort of a meeting between me and Isaac once a week at the end of each week where we discuss a topic. A couple of housekeeping points. There is no advice in this. We are compliance guys. We have to say that. Although this is not regulated conversation, though it's about regulated conversations. Uh, a lot of the views we form on the spot. So today's topic is climate change. We will try to do this in one take. There are no take backsies except for the blubs I had at the beginning. And Isaac's just going to react. So we're just going to sort of share our views on how you go about thinking about climate change risk. Thoughts?
Very good. Let's go.
All right, let's go. Let me just fire up my slides and we'll take it from there. Wait, I need to share my screen first. Share my screen, share. All right, so today's topic is climate change risk. And I know Isaac's doing a lot of thinking. So what I'm going to do is I'm going to talk you through how I'm thinking about it. And let's just build on it and see if we can land on some common ground. So I think of climate change risk in four buckets. There is the assets that you hold and the impact of climate risk on that, climate change. The liabilities, again, the liabilities probably are more relevant for insurers because that's our sort of main area of focus. Your ops, and I am also thinking about customers. Is that something you think about, Isaac? Customers?
Yes, very much so. But I tend to think about them as part of the liabilities. Not because they're a liability, I didn't mean that, but because the customers and their behaviors is what creates an insurance liability that you want to think about.
Yeah.
And it's similar, by the way, in banking. Although there is with the assets, obviously, the banks are making loans and the banks are thinking, who are the customers to whom I'm lending? So I would say it's part of one of the other ones.
But that's the existing customer base. What about future customer base? So if you have in your business plan that you're growing your pipeline and you've got, I don't know, a company that goes bust in 3 years' time that you're going to acquire, sort of get on within your pipeline, then that's not really reflected in your current liabilities.
Agree.
So that's when I say customers. Okay. Yeah, people think about that's my balance sheet. That's the problem I have. Not thinking about actually the guys at the board looking way ahead into the future are also considering customers coming to the pipeline.
Okay, so when you say customers, you're thinking about new customers.
Oh, we'll circle back to it. Anything else missing from these buckets? Do you have any other bucket that you think about?
I suppose the one other bucket that sits across a lot of what's here is the regulators and the wider policy discussions around climate change. You can't just think about those four, ignoring that one. And that one is becoming, I think, more present for many. You just have to look out and see, the Cornwall meetings, the G7, climate change all over there. This week, the PRA announcing the climate change stress testing for banking and insurance. So yeah, I mean, I think regulation matters a great deal here, but.
So you don't see the regulation impacting one of these four buckets as opposed to a separate bucket on its own?
Correct. I think it's better to look at it that way, as a kind of a theme that cuts across all of them.
Okay. I think it's something you have to convince me on because I think in a balance sheet term, regulation doesn't live on my balance sheet, neither on the assets or liabilities or projections. It certainly impacts those areas, but we circle back to that. Okay. But I completely see your point. All right, so let's dive down into the assets. So I'm Solvency II through and through. I had to.
I can see that there's no hint of banking here. Well, counterparties.
Interest equity, yeah, counterparties, yeah, that's right, yeah.
Yeah, that's only a hint of banking, but that's okay.
What would you add for banking?
I mean, the banking is the counterparties to your loans.
Give me 1 second. I have to check if I'm recording this. I think I am. Wait.
Yes, you are. I can see the sign on the left hand side of my screen.
See, teething problems. This is what happens when you try to reboot something on day one. Just for those who are still with us, we had a chat on Wednesday to do this, and I just finished the slides 2 minutes before we hit record. So there you have it. Sorry, yeah, go on. Banking, what would you add?
No, it's not about adding. It's just giving a different meaning to counterparties. You're thinking of counterparties in the sense of trading counterparties, from a Solvency II perspective, whereas for banking, it's the loan counterparties.
Oh, I also had reinsurers in mind, actually.
Okay, fine, sure, but yeah, okay, but for the bank, it's really the counterparties to your loan.
Yeah.
And the big commercial clients that are your counterparties. That's I think the key thing. And in fact, from a banking perspective, the one of the things the PRA has made clear in the as part of the stress testing that they're going to be doing over the next year is that the focus for banking is a loan book. It's not a trading book.
So, oh, wow. Okay.
So the others, well, no, the property could be loans. So yeah, but the equity certainly would not be in scope for banks.
Okay, so I thought maybe if we go one, so we tackle each one of these separately and sort of think about what is the risk posed to that category by climate change. So for equities, I think you're doing a lot of work on it. A lot of people are doing a lot of work on it around the ESG. So I think that's the answer. Mm-hmm. You would get someone to tell you the ESG score of the equities you hold. Is that also happening with bonds?
Sovereigns is still an issue. For corporate bonds, you start to see a little bit of that, because at the end of the day, there is an issuer that can be assessed.
Oh yeah, because
in a way,
it's the same assessment as for their equity in the market versus their bonds in the market.
Yeah.
What about bonds like cat risk bonds?
Pass.
Fair enough, but yeah, it's just one of those things. I've been thinking about so that's, I think the equities and interest is covered through the equities and bonds products. From a property perspective, I reckon flood risk is one of them.
Well, hold on. If you're thinking about flood risk, you're telling me that you're thinking about the kind of the integrity of the property.
Correct, because if you hold investment property on your balance sheet as an asset, then that investment property is at risk due to climate change, and those risks are flood risk.
Yes.
I also think the delta in the temperature is just increasing, is widening. So some of the material that they've used to build buildings may not. Sorry, go on.
No, go on. You go on.
Yeah, so they may not be robust enough to manage the range of the temperatures as those temperatures push out, and therefore that risks the value of your property as you start thinking about the property risk on your portfolio.
Yep.
I think more. Sorry, go on.
But there is another property risk that it's quite important for many, which comes from more from a regulatory perspective. So I'll give you perhaps the most common example, which is the residential property lending, which is shaped by lending for rentals. And there are now requirements about the minimum EPC, the environmental standards that a property must have to be allowed to go into the rental market. Now, I'm not good with with letters to remember what's the current rating, but it's been already increased once recently, and there is no secret. There isn't a secret that that rating is only going to go up in the future. Now, as that rating goes up, if you may find that a property is not anymore available for rental unless you invest in it. So any market valuation of properties and any loan to values and any exposures to a book of lending for rentals is also subjected to some climate change risks, even if the property is not subject to flooding risks, for example.
I think I'm now sold on that extra category you suggested, regulatory. I can now see how regulatory changes should sit separately and just touches all those 4 bits we talked about. I'm sold. What about the changes in how people are living and working, like the recent pandemic? Suddenly, what you thought a portfolio property that's close to a big city, and you go, you know what, it's a great commute line, and now you're seeing that people are moving out, and suddenly, you know what, the rental value is going down, the property value is going down because people are. Is that something you think is it too early to consider that, or?
But I could ask you the question: why is that climate change? I mean, I'm not disputing the impact.
Good point. So if I put a climate change spin on it,
yes,
as things start to heat up, right now, a property facing a river fetches 4x than a property not facing a river.
Okay.
As climate change starts becoming real, suddenly no one wants to be near a river. Suddenly, a property that's on a high ground away from any water body is a desired location.
Yeah, but that's not okay. No, I agree with that, but that's nothing to do with COVID-19 and people not.
Oh yeah. So I led with the wrong example, but that's why I spun that example out. Okay. This is exactly why this is live, right? Otherwise, we would have cut this out. But yeah, so if I was to shift that to a climate-related reason, would be that maybe people's desirability for certain type of property changes over time as climate change becomes more real.
Oh, yeah, so that might happen, but I think
it's too early.
It's too early, exactly. I mean, in terms of the likely impacts, I think people have more pressing things to think about. That might be a little bit parochial and short-sighted, but yeah, I mean, I think the bigger things to think about at the moment, the EPC we were discussing earlier. I mean, just to give you another one, which could be also important for insurers. As far as I know, the environmental standards for properties are only for residential properties, right? That's ones we know about. In the future, you might have environmental standards for commercial properties, for office buildings.
Yeah,
and if you think of insurers, the portfolios they have of commercial properties,
they're huge. I can think of one life insurer, huge, because they have to match the assets and liabilities.
The rationale is there, but suddenly they might find that climate change is having another impact.
Can I just ask your background? Is it because we're going to discuss climate change that you've got that background? With the hand
yes, and yes. So we're talking. We've got a couple of clients.
No, sorry, I meant your literal background to the image.
Oh, the image. Yes. Exactly.
It's very appropriate. Yes. Very appropriate.
Well, I knew the subject, so I thought I'll put out.
That's all you knew. You didn't see these slides. What about counterparties? How are you thinking about that? How do you go about kicking the tires on that?
I mean, for me, the counterparties. You're thinking here of financial counterparties?
I'm thinking reinsurers. I'm thinking you mentioned sort of the loan book.
Yes. So, I mean, I think the issue, I'm not entirely clear about it in my own mind, because for for an insurer, the reinsurance exposure is the exposure of the reinsurer to climate change is a kind of a second order impact, if you see what I mean.
It's a look-through type thing, almost.
Yeah, I mean, I guess I think what I'm trying to say is that, if A makes a loan to B, you can look through that loan and you can understand the financial position of B, and then assess how that exposure might be affected by climate change. But if A is reinsured by B, then B has a very wide business, which would be affected in many different ways as a result of climate change. So looking through that and taking a view about how is um, that relationship being affected by climate change, I think it's a little bit more complicated than the first one.
It's paralysis by analysis, effectively.
Yes.
Where you then just get lost in chasing your tail on numbers.
Yeah.
I mean, the way I've been thinking about it is, if it's big enough, it will have an ESG rating.
Yeah. So I guess
as a business, as opposed to as a business.
Yes, but I think so. So one way will be to think about those reinsurance kind of counterparties in terms of the ESG ratings. But I think even that has to be taken with a big pinch of salt, because my understanding, and I'm not really close to it, is that those ESG ratings are still a little bit in their infancy.
Because everyone's got their own model. And exactly. I think it's the governance. It's very hard to quantify such a subjective measure. Like, what is good governance?
I don't know. I'm not close enough if the disputes are on the E, the S, on the G. But what I've heard a number of times is that you look at one issuer and you look at 3 ratings and you get 3 different views.
Yeah.
So if you're going to rely on that to assess your reinsurance counterparties, you might find that it's all path dependent. You choose that rating and the impact is very different if you choose the other rating. And why is that, right or wrong? Well,
you then look to see what gives you the lowest number. The magic actuary chin rub. Won't go into that. Yeah, I think it might be too early for counterparty to really start doing any deep dive work on the counterparty side of things.
I think there are 2 aspects. I think there is a question about starting to think about the subject, and then there is the question of how much you take the results at face value. I mean, if I just go back to the PRA for a second, the materials that they published are very clear that this is a learning exercise, that yes, they need to understand better what are those impacts. So I think it's something where people should be thinking about and see how far they can go.
Cool, sounds good. I think we've done assets.
Yeah, I think we're
done. Let's look at liabilities. This is so much insurance. It's ridiculous. I guess first question, what would you add here for banks? Loan books on the liability side? No.
Oh, no, that's an asset. No,
that's an asset. Customers are the deposits are the liabilities. See, within financial services, the liability side for banks, asset managers, payments, all these other companies are boring. The most exciting liability side is insurance, because that's like people with fingers in the air, rubbing chins, coming up with numbers. So let's just stick with insurance, I guess. So again, in line with Solvency II, reserves. I think reserves are no. Before I share my thoughts, let's hear what you've got on your mind.
Not much on reserves, because I mean
it's quite mature. The modeling is quite mature.
Exactly.
There's always some bit of fat that sat there to smooth out the results. The more exciting stuff is premiums, but even premiums, I think for a short tail business, not an issue. 1 year, you get to reprice it. not a problem. It's only the life insurance business or life business that really needs to think about premiums.
I think I'm going to disagree with you here.
All right, let's hear it.
And I wouldn't claim to have an answer, but I think if there is a line of business that is fundamentally affected by climate change, and I don't have a view about what that line might be, but if there is one, repricing is a way of hedging or limiting your risks. I agree with that. But from a strategic perspective, repricing the business can be a little bit like this, the old story of the frog in the pan and the water kind of heating up.
Yeah,
You're not jumping, you're just repricing.
yeah,
So you could be so for example, you could then be sitting, you could keep repricing a business that is shrinking. Do you want to be there when the business is shrinking and it's becoming riskier in terms of the reserves and the exposures that you've got? So yes, I
that's
mean,
a good point.
as a tactical way, yes, repricing works, but as a strategic way of thinking, it doesn't, to my mind.
But what about when there is a massive event like a hurricane of some sort, and suddenly it's on everyone's mind? I don't know, the market hardens off whichever way it goes.
Mhm.
Suddenly people are like, you know what, I want to get insured because I don't want this happening to me.
No,
I,
that's fine. That's
I
fine.
will pay whatever. And then you can so then you can sort of really boil the water and the frog won't jump out
Yeah, no,
because the
so that's
frog is
fine. That's fine. I'm not disputing that those kind of mood swings in the market. I'm just talking about the narrow perspective of repricing as a way of
got
managing
it.
the strategic risk of climate change. That's all.
So if you were at a board, what would you be doing to manage the liabilities? Or I'm going to take reserves and premiums together because they normally go hand in hand. What would you be thinking about uh, to manage that risk?
I think I think the first thing you've said is quite a wise thing. That you said to manage the risk. Now, to me, manage the risk means that you're not exiting.
Oh yeah, oh, absolutely, yeah.
But there are, as we all know, there are pressures to exit certain lines of business, coal, for example. Now, that might work in terms of an individual company, but if we want to manage down in an orderly manner that sector in the economy, because we need to switch to a low carbon economy,
Yeah,
pulling out all the risk, all the insurance that they need is not the answer either. Someone will have to provide the
fair point.
insurance cover that those type of businesses need, and for 10 or 15 or 20 years. I mean, we're not going to get out of coal tomorrow, but let's face it.
Because a lot of infrastructure depends on it because it's
Exactly.
geared towards it.
Exactly. So I think the first thing is to be very clear that it's about managing. Uh,
Yeah,
you may want to make a judgment to exit certain things, but I think that's a judgment that has to be done um, thinking, perhaps dare I say, not just about your own financial position, but also taking the wider perspective. If everyone did the same thing, we could have a very disorderly situation where power stations won't have the coal that we need for the electricity to have this coal.
yeah, but I guess a counter to that is if everyone exits the market, i.e., all the insurers exit the market, the demand goes through the roof, and it's the suppliers' market. So they any one insurer can step in and say, you know what, I want to charge you $2 million for the
Yeah,
insurance that you're paying $500,000 for last year. They'll
yeah,
be like, yeah, we'll do it, and then suddenly everyone's like, hold on, this is a nice price,
yeah,
let's come in. So I think free markets find a way
yeah.
to balance out. But I agree with
Agree.
your point about just because it's going in a direction where you don't want to go, you just simply don't get out. You just sort of manage that
Exactly.
exit.
Exactly. So that's the first thing. The second thing about it is something that you see whenever you talk, or you see or you hear whenever you talk to insurers. which is data. If you want to take a view about climate change exposures for a particular insurance counterparty, you need data and you need systems, and you need to collect you need the ability to collect that data, and you need the ability to read it in an intelligent manner and draw conclusions. So there is a lot here that I'm picking up from people about spending time and effort in terms of how, how do we change the underwriting processes to ensure that we can start to understand this risk that
So you make
has
a,
been, sorry,
sorry, go on, go on, go on, go on.
no, I was just going to say to understand this risk that has been there, but perhaps we didn't have to worry so much in the past. That's all.
You make a very good point about data. What data would you look at? Give me one or two to attempt. If you had a magic wand and you could get the data, forget about the source of the data and how you get it.
I mean, I think the key thing is that, I mean, if I think of, I think at the moment people tend to underwrite risks that sit within a legal entity. So if I have, if I might be buying, if I'm a utility company, I might be buying, insurances for my power stations, and I think in the past, the question about that insurance would have been about a certain types of risks that are relevant to those assets. Now, I think with climate change, you need to understand a bit more about those assets. So for example, if I recall from my consulting days that power stations nuclear power stations tend to be by the sea.
Yeah.
Now, and we saw that in Japan with the tsunami.
Yeah.
Now, if power stations are by the sea, and one of the climate change impacts we're talking about is the rise in sea levels, then what does that tell you about the risks? So beforehand, you were quite happy to think about the safety and all those attributes of the power station that were relevant, but now you have to think about a new one.
So and you're looking at the information outside of the asset you're insuring as opposed to just inside, almost.
No, I think it's also inside. I think I just picked an example that had more of a flavor of the outside, but I think it's about thinking, okay, this is the asset. What are the risks that are relevant? Some may be from the outside, like this one, but some may be from the inside, and you have to think it through and then identify what new bits of data you need.
I like that. That's good. And when it comes to lapses, what are you thinking? Because the way I'm thinking about lapses is, let's say you've got a great book of business, but the...
Sorry, you're thinking life right now.
I'm just thinking, yes, I'm thinking life. I think with non-life, with one year sort of short-term business. I mean, climate change is a slow-moving beast. It's like a big tanker. You see it coming miles away. So I think with the life insurers, they have more of an agility to move around. Health, medium, but life are just really slow-moving, so they won't be able to move as much. So yeah, what are your thoughts on lapses for long-term contracts, maybe for even long-term commercial contracts, where the customer goes bust?
You mean group contracts?
So let's say I am insuring for the next 5 years or a long-term insurance contract for a resort by the sea. And it's good risk, but they go bust. And they lapse. That will have an impact on your projected cash flows that you've sort of pushed out in your capital modeling, no?
But equally, you could argue, I mean, I'm not close enough to those models, but equally you could argue that if you cease to be on risk, then
that argument,
you only lose the marginal amount that might have been due for payment around the time of insolvency, assuming obviously that is all spread evenly, if which I think is not unreasonable.
Yeah, no, fair enough. I was thinking more like from contract boundaries perspective, my favorite topic,
Oh God.
because you have baked in, let's say you've got a very juicy business, right? It's giving you
I
great
think
margins.
I think at this point I have to take responsibility for bringing you into regulation.
What did they end up calling it?
I have no idea.
They didn't call it liquidity premium. They called it something else. I can't remember.
Matching adjustment.
No, I think my other matching adjustment was for the equities that the French wanted. No,
No.
no, that was equity
Liquidity.
volatility.
No.
Yeah, yeah.
The liquidity premium became the matching
Matching
adjustment.
adjustment. That's right. That's right. That's right.
But
That's right.
you know the contract boundaries. My God.
IFRS phase 2 as well. Anyways, so yeah, so I mean, I was thinking from a point of view, you've got a long-term contracts, really juicy business, very low loss ratios, and that's really propping up your projected growth or projected capital requirements from other loss-making business. If you lose the business you don't want to lose as part of the lapses due to climate change, maybe I'm going into the weeds, but that's how I was thinking about lapses. Maybe it's too early, just like with counterparty risk. It's too early to think about it, but that's where I was heading.
Okay.
Would you care to punch holes in that theory?
Nope.
Okay.
Your theory sounds like one we need to wait until it's.
So it's because you don't buy it, you don't want to punch holes at it, or is it because? Okay, fine. The last one I had was cat risk. I mean, that's not new. I think a lot of big reinsurers have modeled the hell out of it the last couple of years. Thoughts?
Okay. I think there is a lot of. I mean, the technical people that understand cat risks are still arguing a great deal about the difference between the weather and climate change. And one of the big challenges they have, as far as I can understand, so take it with a big pinch of salt, is that they see events, they see weather events, but then there are big discussions about whether those events are caused by climate change or is what you would have expected to see anyway.
Got it.
So I don't know what to make of it, if I have to be perfectly honest with you and everyone else listening. But I think that there is something there that I think is worth thinking about because, there were always going to be floods, hurricanes, etc. So we can't just say that everything is now because of climate change.
Fair enough. Yeah.
And I think it's about understanding what's the delta that climate change is bringing.
Yeah, I know that there are a lot cleverer people with a lot of math behind them thinking about this problem. So I won't even attempt to have a go at this.
Yeah.
Anything else on the liabilities before we move on to the ops side?
Nope. I think you covered it pretty well with this slide.
Perfect. Ops. This is where I was running out of time on the slides. So bear with me. So the way I think about ops is your carbon footprint and how that impacts it. So things like travel, and what I mean by travel is not the fact that you're traveling and contributing to climate change, but the fact that the cost of travel is going up as a result of climate change. Maybe there are, I don't know, penalties for large corporations. I don't know. I guess before we delve into each of those topics, anything you see missing from here or disagree with?
Reputation.
So high level.
Reputation. Is that about ops or is that about everything?
It's about everything, but I just I had 4 buckets. I had to put it somewhere, so I put it in ops.
Okay, fine. Yeah.
But you're right. It's about everything.
Okay. Yep, that's what I wanted to double check.
You mean you wanted to hear?
Yes.
Anything else you put in there? I mean, I was light on it. If I was at an insurance company, I probably wouldn't be factoring it in too much.
So I think the other aspect of climate change, I mean, obviously within office, the two different things to think about. There is obviously the electricity consumption and the CO2 emissions that come out of that. But then there is also all the, the proverbial plastic caps and all that.
And the paper and the printing.
And the paper and the printing and all that.
Single-sided printing that you throw away because you printed the wrong 200-page document.
Exactly. So within Office, I think it's worth thinking about those two different things. The electricity, and that's the scope 1 and 2 for the TCFD disclosures, and then everything else that it's also consuming resources one way or another, like the plastic caps and the papers and the toners and all that.
Would you consider commute to the office as part of the office or the business contribution to the carbon footprint?
It is. You're supposed to account it for exactly like that.
So your daily commute, you're accounting. I did not know that.
Yeah.
So you.
Yeah. Well, in fact, one of the discussions we've been having recently is the flip side. Well, I'm not sure if yes, it's the flip side of that one. Yes. So if people are now working from home, and we have to account for our own carbon emissions from our operations, how do we account for that? Because and there is an argument to say that that's not very efficient. I mean, the travel could swing it, but if you have 200 people working in an office building, you're heating up that one office building. That's probably more efficient than having the 200 people working in 200 homes that now have to be heated because they are there, and they would not have been there before.
Yeah.
So there's a few swings and roundabouts here with the office emissions that need to be thought through.
What are your thoughts on data centers? So effectively, everything's moving onto the cloud. Just this call itself, it's going to somewhere in the US and then coming to you. Like I think I read somewhere that a cost of watching a YouTube video for 30 minutes is equivalent to 4 miles of driving. Something along those lines. I could be wrong. I'll post that somewhere on the notes for this. Are people thinking about that? The cost of electricity, but that's happening in a data center somewhere far away.
Yes, you should think about that. I mean, the scope 3 of carbon emissions is about upstream and downstream. So I don't know where you want to put the third-party provider, if it's upstream or downstream. But yeah, you should be thinking about that. I mean, I think the challenge with climate change is that there are so many things to think about that you got to be pretty ruthless about the prioritization.
Agreed. Yeah.
And some things may be important, but you may not be able to give them the attention that they probably deserve in the short term, because you need to be looking perhaps at your own, your electricity consumption in the building.
You know what this statement is going to lead me to a question: that what are your top 3 things you'd look at? But we'll circle back to that at the end when you're thinking about climate change. I think I don't want to spend more time on ops because I think this is probably something that could potentially get lost in the rounding. In the grand scheme of things.
Oh yeah, and for insurance and banks, I mean, the PRA has been very clear. That's not the reason why we want you to think about climate change.
Yeah, it's on the other side of the balance sheet.
Exactly, it's the other side of the balance sheet. Well, both sides of the balance sheet. That's just your ops. Okay, if you can do it more efficiently, that will be good for the environment and for everyone. But the key thing is those financed emissions, as which we've been talking before. So yeah, let's move on.
So just one quick question then. It just triggered. If I'm a big corporate who's got some equity in the market, so who's got some shares in the market they're selling and some bonds in the market, and people are calculating my ESG, to what extent are they looking at my ops, sort of how green my ops are? So if you take a bank, any bank, let's say HSBC. HSBC's got ESG rating.
I don't know enough. I mean, my guess is that they should be looking at that bank's disclosures and see the extent to which they are uh, publishing data about their own CO2 emissions, and ideally benchmark that. But I have no idea the extent to which they do that.
I'm going to check it out. I'm going to check it out over the weekend.
Yep.
All right, and lastly, at customers, I just had new business and existing business. So I think existing business is already covered elsewhere.
Yep. I
and then it's the new business. It's the how are we on time?
Well, I mean, if we want to keep this to an hour, we're running short.
Yeah, no, I think we're almost done because there's not much to talk about in the new business. So my only view from a new business perspective is the 5-year plan, the 10-year plan that the board's setting, which assumes a certain number of new business being acquired. And it's really around, will that new business be there by the time you get there?
No, but you're right, Walid. But those 5-year plans have always been very dynamic, and even before climate change hit us, it would have been exactly like you said. By the 5th year, you would be dealing with type of customers that you didn't quite anticipate when you started. So, in that sense, I don't think the world is changing that much.
That is the right answer, because I was speaking to someone else about it as well, and they're like, "Well."
And what did they say?
They say the business model for the business itself keeps evolving. So as the customers start dropping off, or you can see them start dropping off, you would just work around it and find new markets and pivot. And if you don't, then climate change or no climate change, you are a going concern. No, you're not a going concern. Yeah. However that works out. That's all the slides I had. I think that's all the slides I had.
Okay.
Cool. I think it's certainly improved my views on climate change a little bit. Getting your thoughts.
Yours as well.
I think we should. I think that's the format. I think that's the format we'll have until someone tells us, or until we think, no, this isn't working. What do you want to talk about next week?
Well, we could keep talking about a little bit about.
Let's pick a topic that we don't know anything about. And just to be clear, normally when you ask Isaac, you know nothing about. We are both from that regulator, so I guess we know Solvency II because we wrote some of it.
Okay, why don't we talk about payments?
Payments? How about IDD? What are your thoughts on IDD? No, let's do payments because it's too insurance otherwise. Anything specific in payments, or just general ecosystem and regulatory requirements?
Yeah, I'm quite happy to hear a little bit about payments.
All right, let's do that. I will share my thoughts on payments. I think the rule we'll have, just to keep it light, sort of the overhead light at our end, is we'll spend 2 to 3 hours, no more than that, just forming a view, and then we can. That was my son, if you heard him, and then we just form a consolidated view.
Okay.
Make sense?
Makes sense.
All right. In that case, I think that's all for this week. Any final words?
No, I think it's been good to go back into it.
Yes, I was quite interested, quite keen to reboot RegNut, which is what we've done.
And we're doing it in the manner of the 21st century, not Zoom.
On Zoom with the same. Can you see my screen? Am I recording? What's happening? It's like all those anxieties that come with doing an online call.
Super.
All right, super. Great. I'm going to stop recording now. Bye-bye, everyone.
Have a good weekend. Bye.